Hello, everyone, and thank you for joining us during the Lytham Partners Spring 2024 Investor Conference. My name is Roger Weiss, and I'm a Vice President of Lytham Partners. In this segment, we welcome Dan Gluck, a co-founder and managing partner of GroundForce Capital, a San Francisco-based PE firm focused on food, agriculture, and ag tech, decarbonization, supply chain, and low emissions manufacturing and production. Earlier in his career, Dan spent about 15 years on the buy side with Weiss multi-strategy partners in a variety of roles, including portfolio manager, partner, and member of the executive committee. He also founded Health Warrior, a plant-based CPG food company whose products are sold in over 13,000 retail locations and which was successfully monetized with a sale to PepsiCo in 2018. Dan was a Division I tennis player turned endurance athlete, competing in marathons, ultramarathons, and several Ironman triathlons. He and his family reside in the Bay Area. All right, Dan, let's begin.
Wonderful. Thank you, Roger. Good to see you.
Good seeing you. Dan, could you please introduce yourself and give us a brief overview of GroundForce and perhaps talk a little bit about the difference between private equity growth investing and public equity investing?
Yeah, sure. So you did a great job giving the intro, so I don't need to say too much more, but as you alluded to, started my career in the institutional investment world in the hedge fund world, working for George Weiss at Weiss Multi-Strategy Partners. That's really where I cut my teeth in finance and investing, had an amazing career there. Along the way, I always had a real interest in health and wellness, exemplified by my interest in tennis, playing Division I tennis, and then becoming an endurance athlete, competing in triathlons and marathons. I've done some Ironmans, obstacle racing. And that's when I discovered chia seeds after reading the New York Times best-selling book, Born to Run, all about the Tarahumara tribe in Mexico who live in the Copper Mountains, live off the earth, and they're a tribe that are known as these amazing endurance runners. And in the book, one of the amazing realizations that I had and epiphanies was they talked a lot about how they were sustain themselves on their long endurance runs, and that was through the power of chia seeds. And so with that, I decided to scratch my entrepreneurial itch, and I co-founded a brand called Health Warrior. Our first product to market was in the nutritional bar category. It was a chia bar. Chia was the first ingredient, packed with antioxidants, omega-3s, high source of plant-based protein. We built that, we scaled that, raised private equity capital, and then eventually, as you mentioned, we sold the business to Pepsi. And so after the experiences I had as an institutional investor, as well as a founder, building, scaling, and ultimately exiting a business in the CPG food world, I wanted to find that intersection. And that's what led me to where I am today. And so today I'm one of the co-founders and co-managing partners of GroundForce Capital. We are a growth equity fund investing out of a $330 million fund into emerging consumer food, beverage, food service, food tech companies, as well as some B2B businesses that are what I would describe as consumer enablement companies, supply chain technology, co-manufacturing businesses in the beverage and food space, looking at some ag tech type companies as well. We typically look to invest in companies that are generating revenues between $20 and $100 million plus in revenues. Typically, we want to find companies that are either profitable or with our capital, we can get them to profitability. We can bridge that gap, and we believe that's a great opportunity to create a lot of value for companies. And so and the last thing I'll just share is typically we're minority investors. We can take majority stakes in companies, and we have some control investments, but by and large, we're typically minority investors. And typically we'll take one board seat, have anywhere between 10 and 30% ownership of a company, and work hand in hand with our companies.
Got it. Very interesting.
Oh, and then you did ask about, I guess, the difference between private equity and public equity investing.
Yes.
Yeah, so it was an interesting transition, for me, from having spent 15 years on the buy side at a large hedge fund. moving towards the private markets, particularly given we are not control investors. We're just passive minority and well, I shouldn't say passive, but minority investors. And some of the biggest differences that I recognize start with time. The investment period of a traditional PE or VC fund, it's a 10-year life fund. It's a 5-year investment period, and then you typically are still even deploying and follow-on capital in the subsequent 5 years, but ultimately trying to monetize those investments, up until year 10. A lot of funds even have, options to extend. And so sometimes you'll see life of funds extend all the way to 12 years. And so unlike the hedge fund industry, where typically, and every hedge fund has a different model, of course, but typically, and I was in a multi-strat fund, you are being analyzed on your year-over-year performance. And often, not only year-over-year, quarter-over-quarter, month-to-month, and sometimes weekly. I remember, in our hedge fund, we had some investors, literally, we would underperform or outperform the market, and our LPs, investors would ask us, what was driving them. And so, with this, we've got time on our side, and that really helps us be able to sort of not out of fear ever. You can make better decisions, I think, with that long-term view. Second biggest difference is sourcing. It's competitive. Typically you only will have one or a few investors that have the opportunity to invest in a private company. Whereas in public companies, they're accessible to anyone with a brokerage account, which really can be anyone these days. And so thus sourcing really becomes the lifeblood of VC and PE firms. And that's something that we spend a lot of time on, building relationships, identifying companies. And as part of that process, because these are private companies, you also don't have as much transparency. You don't have as much readily available information as you do in the public markets, where you can't just run a screen off of Bloomberg, screening for companies with a certain growth rate, margin profile, sector. That doesn't really work in the private market. So sourcing is something that is a big differentiating factor in private market investing. And then the last two I'll just mention is value add. And again, every hedge fund has a different model, but by and large, most hedge funds are not necessarily working, or even any public equity investor, I should say, not just hedge funds, but mutual funds, aren't working hand in hand with the companies and the management teams operating these companies. Sure, some of the largest investors in companies or activists might play a role in that, but by and large, most public market investors are passive. Whereas when I stepped into this role as a private market investor, I know that I have a real opportunity to impact the future, results of this company that we're investing in and that we're working in. And we spend a lot of time with our companies, work with our value add toolkit. And then the last thing that I'll mention, and I would actually say this is one of the biggest differences that I really had to sort of manage and think through thoughtfully and put some work to, it's just managing the personalities and character traits of the founding teams. It's kind of building on that value add toolkit we have and working closely with management teams. But you've got to figure out ways of how to communicate well with your management teams, how to build trust, how to build strong relationships, and how to also give them the right space, but also make sure that there's some accountability at the board level. And if we have 20, 40, $50 million invested in a company and own 30%, you certainly want to be vigilant, but you also want to give that team some room to run. And so, just spending time on thinking through the proper techniques and modalities of communication and working and building trust has been something where I've personally invested a lot of time. And I think, most good private equity or venture investors have to do that as well.
Very good. So some major league differences between one and the other. So,
yes.
When you started this, I think the shop, when you founded it, was called Power Plant, and a few years back you changed it to GroundForce. As the shop has grown and evolved, how have the investment goals changed from when you co-founded the shop to where are they now?
Yeah, so our firm has its roots back all the way to 2015. Which I was actually not part of that original founding team. One of my current partners is, two of the other partners who were involved early on have transitioned out. But the original thesis for power plant was that our global food system is broken. It's unhealthy, it's unsustainable, it's inefficient. When you think about, the global ag market is a major contributor to greenhouse gas emissions. We're challenged to feed the growing population. Chronic diseases are on the rise, just cardiovascular disease and diabetes, which have all proven they can be prevented and reversed with proper nutrition. And so many studies ultimately pointed to the benefits of a plant-based diet as it relates to both healthy planet as well as healthy people. And so that was really sort of the underlying current and mission of the firm initially when it launched, was that there's a problem and there's a very easy way to solve it. And that is through a more sustainable, diet. And plant-based at the time was really just beginning to break out in terms of the trends that you were seeing and the awareness that people were having for the benefits, either from a climate perspective or from a human health perspective. And we were early to that. We definitely were ahead of the curve. And that's really where our fund had its roots. However, what we learned, and particularly when I joined what is now my partner, Mark, we realized that there was a much bigger opportunity. Investing in early stage plant-based food companies was a very niche product. And we saw there was a bigger opportunity to expand well beyond plant-based and even beyond just food and beverage companies as well. And so ultimately, we transitioned our firm to move away from early stage VC investing in just plant-based to what we are now investing out of a growth equity fund. As I mentioned, we're now looking at typically Series C and D rounds in companies generating revenues between $20 and $100 million. And we've also broadened our mandate. So it's not just about plant-based, but actually we still are rooted in two impact pillars around promoting healthy lifestyles and also transitioning to a more regenerative and lower carbon food system. But the plant-based isn't the only way to get there. We think there are many different ways and companies out there that can help achieve those impact pillars and goals. And so with that, we changed our strategy and we changed our name, right, to GroundForce. And GroundForce ultimately is a symbol of our evolution and of our growth of the firm and our vision for the future. And we landed on this unofficial tagline around being grounded in excellence and a force for good. And those are two lofty goals that I can wake up every morning and get out of bed to go to work for.
That's great. We, I guess, talked about now the big picture. So maybe we can talk about how you take the big picture and apply it to, looking at individual companies. What makes a company attractive to you, and especially as an earlier stage investor?
So we're not just thematic investors by any means. We spend a lot of time bottom-up analysis, as you would say, maybe a value or growth-oriented investor mindset. And one of the areas that we typically like to start with is sort of this concept of start with why. There's a great marketing and strategy guru, Simon Sinek, and he talks about how every great brand starts with the why, meaning what is their North Star? Why do they exist beyond making money? The why serves as a compass, ultimately, guiding all decisions and actions, both internally and externally. And so, for example, Apple never says, we're a tech company selling consumer hardware. No. Instead, everyone knows Apple's mission is to make the best products on Earth and to leave the world better than we found it. And so that's something that as we first start to talk to management teams, I really like to understand their why and understand sort of what's the deeper reason that they started this business. Is there something more that gets them out of bed than just making money, which making money is table stakes, right? But I want to see sort of if there's something that's deeper. So that's number one. Number two is finding a moat is really important. Moats are really important. What is the point of differentiation? What makes this company remarkable, whether it's about the product, the service, or the brand that they're offering? And that's particularly important for us because traditionally, and as I said, we've been evolving into new areas of investment, but traditionally, our roots are investing in consumer brands, consumer, CPG, food and beverage, where it is hard to have differentiation, right? Barriers to entry are very low, and so typically there aren't many moats. A lot of these companies don't have real IP to surround themselves with. So we have to look really deep and understand, well, what is unique within the CPG category about this brand or product or service they're offering. And then the last two I'll just mention, which one is stating the obvious, but it is we're spending a lot of time on their financials. We need to see strong growth. We need to see strong margins. We want to see strong velocities, and so that's all obvious, and maybe we can talk about that a little more later. And then of course, same thing, team. And I think we're going to be spending some time talking about that, but certainly team matters. We know this, whether it's a public company, whether it's a private company, you've got to have great operators at the helm.
Right. I think earlier you did say that you were looking for companies that were already generating revenues. And you talked about a lot of the things that, really provide interest to you. I guess specifically, are there sectors, business models, technologies where you're really interested now? And so when you see these kind of companies, you say, this is something I need to dig in a little bit further.
Yes. So as I mentioned, at the macro level, we focus on investing in consumer food, beverage, food service, food tech, and also spending increasingly amount of time on B2B companies that enable consumer brands, supply chain technology, co-manufacturing, ag tech companies, and even SaaS-based companies related to the food system. But within that, there are definitely a few trends and themes where we're spending a lot of time and looking to identify opportunities. Starting with one area that continues to interest us is vitamins and supplements. There's nothing new here, but the category is continually evolving. It's continuing to grow. It's also, from an investment perspective, an attractive category because typically these are businesses that have very high margins. And so that's one area of interest. Another area of interest for us is in beauty care and personal care. We're particularly around skin care and hair care, and preferably brands that have clinical claims behind them. The way we see it, you've certainly already seen a lot of M&A in the last just couple of years around beauty care. But we've been identifying this trend for now 2 to 3 years, and what we keep saying is that the beauty industry is several years behind the food and beverage industry in terms of their evolution around focusing on cleaner and greener ingredients. And so we think that trend is going to only continue to grow, to evolve from here. So we're continuing to spend a lot of time there. And as I said, that clinical claims is an interesting component just because it begins to differentiate the business from those that typically would not have any type of real claim to it. And again, that speaks to sort of us looking for some sort of differentiation or moat. A few other areas where we've been spending some time on and putting some efforts into understanding and researching, which are companies with consumer products that are complementary to GLP-1s. We've seen a lot of growth of these drugs. A lot of people are taking them. And we believe there's a certain foods and beverage brands that will benefit and will be complementary to those who are taking GLP-1s. And then last, sort of contrary to that last theme, is this idea of food as medicine. We are looking for companies that are creating medically tailored meals that will then ultimately become reimbursed by health insurance companies. It's a very growing and nascent category. You're beginning to see some companies work closely with the health insurers and actually be able to get their consumers to get reimbursed for them. And we think this is going to become a growing category. So we're spending time here as well.
I started actually my first career out of college in the cosmetics business.
I didn't know that.
On the finance side. So.
All right. Well, maybe we'll loop you in as an advisor on our next deal.
I'd be careful about that. when you look at various or potential market opportunities, Dan, you know, how do you evaluate both the opportunity and the growth prospects of any, you know, company that's starting up, and what data points or metrics really are key for you when you look at these kind of companies?
Yeah, look, you know, while we're focused on, broadly speaking, the food and ag industry, and as I said, expanding into personal care and beauty, uh, the reality is that, you know, each company is very different in terms of how we would look at it. So maybe the easiest way for me to answer that question, given how much time we spend on traditional CPG food and beverage companies, is to talk a little about some of the metrics, what we look for there, which one of the key points that we start with is looking at velocity. We want to see strong sell-through numbers on the shelf. Yeah, I don't want to say anybody, but it's rather easy if you have a good brand or product to get on the shelf. Retailers like a Whole Foods or a Target, they always want to know what the new products are. If something is sort of the new shiny and sexy object, they want it on their shelves. They want to see consumer, you know, bring something new to their consumers. They need to draw consumers into their store. So it's easy to get on shelf, but then ultimately, how well does your product turn? That's what's important to us. We want to see ultimately category leading velocity numbers relative to peers. So just by way of example, if you have a new chip company, we want to make sure that you know, your brand and product are outselling the traditional chips that are on shelf already. That to us is something that they're standing out about that business if it's, you know, still early. And the other thing that we want to see, and it sort of speaks to this velocity metric, is the brand bringing incrementality to the category? Retailers love that, meaning they want to see our new customers coming into the category that previously were not consuming in, you know, that product necessarily. And so if you can, as a brand, if you can demonstrate strong outsized velocity numbers and demonstrate to me some case studies of this incrementality, that's something that's unique. So that's like one of the first things that I would look for if someone came to me. And frankly, speaking more on velocity, I'd rather see stronger velocity numbers in less doors and less total dollar sales than I would a company selling in many doors, but lower velocity, even if total dollar sales are higher because they just have more points of distribution. Yeah, that's not always the case. Sometimes you might want to just, you know, go sort of, you know, far and wide, but typically I'd rather see someone with a real focus on one market, one geography, one retailer, and just crush it in those stores and show me that something unique is, you know, there's something unique about this brand. You know, as I'm going to give a quick example of that, we were investors in a brand called Vive Organic. Vive is it's a juice shop. They have highly concentrated and efficacious doses in 2-ounce bottles of things like echinacea and ginger and turmeric. And when we looked at this investment several years ago, they had a small footprint in terms of their retail doors. But for the doors that they were selling in, they were selling 5x what traditional beverage brands sell per week, per store, per unit. And so when you see that type of, you know, outlier in a category, then it gets our attention. And also what was unique about Vive is not only were they outpacing on velocity numbers, but what was really interesting for the retailer was that because of the small size of their product, you know, being just a 2-ounce bottle, if you look at sort of literally, which retailers will, sales per inch effectively or per foot, they look at it, you know, that way. Like a real estate operator would look at rents per square foot. They're looking at the same metrics. And because of those high velocity numbers and because of the shelf space, the minimal shelf space it took up, that was very attractive to retailers. Then we started to see the retailers buy in as well, and the company started gaining a lot of distribution. And that company subsequently went on to be acquired just last year. So, you know, very successful investment for us. And then the last thing I'll just mention is margins. The reality is CPG food is somewhat of a capital intensive business. It's expensive to get on the shelf, it's expensive to stay on the shelf, and it's expensive to advertise. And so if we can't underwrite at least a 40% gross product margin, then it's probably something that would not be an investment for us. We typically like to see at least 40 to 50% gross product margins so that you at least have enough of a healthy margin for your operating expenses and your G&A to be able to generate real cash flow.
Very helpful. From we'll just stay on the, kind of the, I guess, food and CPG and others, but when you look out there, and obviously you've been the entrepreneur, you've built a company, and you've been in the wars, as it were. What are the key challenges and risks from now being on the investing side that you see in both food related and sustainability investments? And how do you as an investor mitigate those risks, either in your due diligence or from a portfolio management standpoint?
Yeah, it's a good question. So what I would say is some of the key challenges, and again, I'm going to focus most of my answers on traditional consumer food and beverage, because depending on the subcategory, my answer would be very different. And so we could spend all day on this question for each company, each category, each subcategory. So, but again, I think there's probably a lot of consumer investors that are in the audience listening to this, and so I'll focus my answers there. Number one is the obvious, which is low barriers to entry. Again, we're speaking about traditional food and beverage. There is no real IP around these products. Anyone with a kitchen can likely produce these products, and so we have to really think about what is differentiated about the product, the brand, their team, that will increase their probability of success. What problem are they solving for the consumer? What problem are they solving for the retailer? There's got to be something special and unique. Second biggest challenge is that these are somewhat discretionary products, typically that, we're investing in. While food is a consumer staple, many of the products and brands that we invest in are more discretionary in nature and can easily be replaced by another product. Starbucks could be replaced by a Dutch Bros, coffee, or a Black Rifle coffee. I mean, consumers have a lot of choice today. And so you need to really sort of, think about, those challenges of understanding that it's very easy for consumers to switch to other brands. And that sort of leads me to sort of the curiosity of the consumer. Ultimately, it's kind of tied to this discretionary nature. And what I mean by that is consumers like to try new things, new products, new services, especially when it comes to brands. There's, what I would say is often there's very little brand loyalty for long-term periods within the consumer world these days. It's very hard to grab their attention, particularly because it's so easy to access consumers via social media these days and tell them why their product is better than another brand or another product. And so those are certainly some of the key challenges. And I would say, as far as mitigants, that's really ultimately what we need to solve as investors in our diligence process. We identify all of the challenges, and then we go and solve for the mitigants, right? In terms of, okay, well, we know that, a brand loyalty is challenging, or it's expensive to acquire new consumers. Well, do they have some sort of interesting flywheel or unique ability to acquire customers cheaply? You see that these days with either just great branding. In the case of, we're investors in a company called Liquid Death, and there's been something very unique about the brand offering that Liquid Death has been able to offer consumers that has driven them towards their products. You see companies these days with that are celebrity or influencer backed, and they already have a huge audience where ultimately their customer acquisition cost is de minimis relative to John Doe, who just launches a brand out of his kitchen and ultimately isn't known in the social media world. No one really knows who this person is. It's hard. You're just going to go buy customers typically. And so those are the types of mitigants, that we always try to solve for. And as I said, depending on sort of the challenge and the risk of the company, again, I could talk about, team risk and we identify that as a yellow flag in our diligence. Well, there's mitigants. There is ways to complement a CEO with a new president. Or if we see that there's team risk and they're lacking in a strong CFO, we say as part of our diligence and our term sheet that it would be required to bring in a new CFO that we have consent rights on, or we want to be able to go and help recruit that individual. So those are some of the key challenges, and we're always thinking through exactly that question. I mean, we have slides, in all of our investment memos. It always is challenges and mitigants. That's a huge part of where we spend our time, because there's always going to be challenges in any business, whether it's a startup, whether it's a growth company, whether it's a mature public company. And so it's our job as investors to identify the challenges and think about the 3 to 5 key mitigants we can have to de-risk the investment.
Really good. If we could dig in just a little bit deeper. What other factors weigh heavily when you're assessing the team and working with them?
Yeah. So at the stage that we're investing, as I said, because we're no longer investing in seed stage or real early stage companies, experience is always paramount. So at this stage that we invest, I prefer to back CEOs with experience. And that's because there's a very different skill set for a founder or CEO to take a company from 0 to 1 than it is growing a company from ultimately 50 million in revenue to 250 million in revenue. It's really rare that it's the same CEO unless they've done it before necessarily. Certainly, there's always exceptions to the rule, but I like to see experience. And then when it comes down to thinking about the teams in particular, there's a lot of character traits that we look for in management teams, and particularly in CEOs or founders, because at the end of the day, their character says a lot about how they're going to run a business. And so there are character traits such as starting with curiosity. Is the CEO curious about learning? Does he or she take feedback well? Do they constantly want to improve? That's like one of the first areas we spend time on trying to identify. Second, we think about accountability. Is the management team or the CEO in question always looking to take responsibility for their own actions? Not playing the blame game, not pointing fingers, oh, the market did this, my supplier did this. We don't like people who are making excuses or that they're the victim. The buck ultimately always stops with the CEO, and they need to take their share of their responsibility and ownership. Doesn't mean they have to take more. They don't need to hear out and take everything on them, but they certainly can't take less than their 100% responsibility. Two other character traits that we like to look for also include trust and just a sense of justice. I'm a big fan of the Navy SEALs, and one of my idols is a former Navy SEAL. His name is Admiral William McRaven. He was also head of Special Ops Forces, and he's written many books. He's given many speeches. I certainly recommend, if anyone doesn't know him, go pick up some of his books or go on YouTube and listen to his commencement speech at University of Texas. But anyway, he talks a lot about a sense of justice and honor. And one of the things he always talks about is this sense of what honor means and what justice means. And it's do not lie, do not steal, and do what you know to be morally correct. And so that's something that, certainly we're always looking for in CEOs and founders. Can we trust them? Do they have a sense of honor and justice? And then last is, and I'm going to continue to actually build off the Navy SEAL theme, which their motto is the only easy day was yesterday. And what that means is it's going to be hard every day. I don't care what business you're running, again, whether it's an early stage startup, whether it's a growth company, whether it's a mature public company that's been around for 50 years. And you know this, we all know this, business is tough, it's challenging. Whoever's in that seat needs to have some grittiness. They've got to be able to have perseverance, put their head down, and be able to push through when times get tough. And so those are some of the main traits that we're looking for.
The University of Texas speech, was that the make your bed?
Exactly. That's it.
very good.
which I can't remember whether the speech came first or the book came first, but there's a book also that I've read more than once. I've read it to my children. I've had my children watch his speech. So really inspirational individual.
Very much so. I know we're getting a little shorter on time, so let me proceed. You know, you've talked about one of your successful companies. You know, could you talk maybe give another example of a successful investment from your portfolio, and what were the key factors, you know, kind of looking back, that contributed to their success?
Yeah, so I referenced Vive, which was acquired by Suja. I also touched upon Liquid Death, which is a really interesting company that we're investors in. We identified Liquid Death when they first launched. Interestingly enough, we actually had a term sheet out for their Series A investment. At the time, the company was generating only $8 million in revenue. And we put in a very aggressive term sheet without going into the details for, you know, and when I say aggressive, I mean an aggressive valuation relative to where traditional CPG businesses trade for in the private markets or in the public markets. Typical revenue multiples when companies aren't profitable are somewhere between 1 and 5 times or so, and that's typically on a trailing 12-month basis. And I can tell you, we came in with a valuation, you know, north of that, and ultimately it wasn't strong enough at the time. The company said, yeah, you're gonna need to come in higher if you want us to accept your term sheet. And at the time, we weren't comfortable. We remained disciplined. However, we stayed close to the company. We tracked their progress, and only a year later, they blew their forecast out of the water. Came out to raise another round, and that's when we got invested in the business in their Series B. Subsequently, they've gone on to raise, you know, a Series E, pre-IPO rounds. Valuation has, you know, certainly progressed tremendously since our initial investment, and as the company just continues to grow at levels that, you know, it's rare to see in the consumer beverage and food space. And what really differentiates this business from others is that it really took the category and the marketing behind it and flipped it on its head. You know, if you look at traditional premium water brands, it's, you know, you've got, think of Fiji or Perrier. You have these beautiful, you know, clear waters with these light blue colors that give you an, you know, an emotive of relaxation and bring you to a beach. And, you know, the founder of Liquid Death, Mike, took a very different approach and said, I'm going to make this fun. I'm going to make people laugh, and I'm going to give premium water to a whole culture that is being denied a premium water brand that speaks to them. And he knew that because he actually sort of fit in that alternative culture as someone who loved music, would go to a lot of concerts. He's got some tattoos and whatnot. And but he doesn't really like drinking alcohol. And he wanted an alternative. He said, but I don't want to be sitting there with a Fiji water at a concert. And so that was how Liquid Death was born. And he took the approach of, I'm going to give people something that they don't have that they want, and I'm going to make it fun. And that's exactly what he's done. And it's working. So that's a really exciting investment. And then just one other that is worth putting on investors, you know, radar screens, particularly for those that are moms and dads with young children, but it's a brand called Bobby. And Bobby is a infant and baby formula company. Launched what we would describe as a European style formula. And I say European style because it has better nutritional profiles than traditional American brands. The EU has higher standards for what goes into, you know, babies' bodies, as they should. And what these two founders who started Bobby realized when they both were moms was that they were importing European brands illegally, technically on the black market, to the United States to be able to feed their babies. And they said, why doesn't this product exist in the United States? And so they launched the brand Bobby and have had tremendous success since launching. We invested in the business in 2023. The business is growing, you know, head over heels. 100% type growth and well into the 9-figure sales these days. And so really interesting company, 2 amazing founders, great management team, mom-led, women-led, and we're certainly excited about their growth prospects to continue this, at this pace.
Very good. I think we're getting close to running out of time, so let me ask one more quick question.
Sure.
Just a kind of a big picture question. We've come out over the last couple of years, the COVID years. We had rates at 0, we had government payments paying for a lot of things, and everybody quarantining at home. There was tremendous optimism in food land, and then we saw plant-based meat take off, cowless milks, all protein. Everybody was getting funded right and left.
Yeah.
Fast forward to today, 5% treasury rates, hefty food inflation, retrenchment in investing by both private equity and the food companies themselves. Kind of where are we and where do you see us going in 2 minutes?
Yeah, so I would say first to start, I would say I'm very bullish. What happened during those years is, and this happened not just in the consumer food and beverage space, but the entire market, of course, in every sector, it just got frothy. It got really, really frothy. You had companies like Beyond Meat and Oatly that were trading at 13, 14, $15 billion market caps on 30 times revenues. Today, they're trading at 500 million. You have companies like Grove Collaborative that IPO'd at $1.5 billion vis-a-vis Richard Branson's Virgin Acquisition Corp SPAC, today trading sub $100 million. You've seen, and the list goes on, from Blue Apron to Sweet Green to Deliveroo. It was a bloodbath. And the problem was ultimately that in our sector, at least in our category, is that investors price these companies like tech companies, and they're not tech companies. These are consumer product companies. And so they don't have the same ability to scale like a traditional tech company. It takes time, it's costly, it's capital intensive. And it's interesting, and I'm not saying we batted 1,000 and we're perfect investors, but as a fund, particularly with its roots around plant-based foods, we pretty much stopped investing in every alt protein and plant-based food company that our investors would have thought we would have invested in, because we just said the valuations don't make sense. We happened to be early in Beyond Meat, and we were fortunate to time that right, and we made, we sold that in its IPO. But once sort of that, we didn't continue to invest and support those companies, and it's been a real bloodbath. And I think though what's interesting is I do think that the trend isn't over in terms of people looking for healthier and better for you alternatives. And so there are companies out there that maybe went public or just are still private which have huge valuations that we're beginning now to see valuations reset. And so we're seeing some really interesting opportunities in the private markets of companies that literally were raising money at valuations of $1 billion and now coming back to market at $100 million valuations. And the same thing is going on in the public markets. I'll certainly, would not be surprised if you see a lot of these companies that were taken public go private again, because they just don't belong in the public markets and they probably just need to recap the entire business. So I'm rather bullish, over the next couple of years of how things will shake out. And I think the trend is still, is a tailwind for the sector. I don't think anyone's going to say, wake up and say, I want to eat unhealthier food. I think that movement towards healthy food, better for you food, with cleaner ingredient, labels is here to stay. And so I think it's just going to create a lot of good opportunities.
Very good. Well, I think we are now officially out of time. So Dan, firstly, thank you so very much for joining us and taking the time today. Obviously, we greatly appreciate it. To the folks who are watching us, thank you again for joining us with this discussion with Dan Gluck, co-founder and managing partner of GroundForce Capital. Please check out some of our other presentations as well. And to request any one-on-ones with our companies, please visit www.lythampartners.com/spring2024. Obviously, click on the one-on-one request button. We hope you all enjoy the conference. Thank you.